Imagine you have a massive vault of US dollars sitting in a bank in New York.
Okay, I'm picturing it.
Now imagine you could magically teleport that vault to India, earn nearly double the interest rate, and somehow completely immunize yourself from the risk of the local currency crashing while your money is there.
I mean, that just sounds like a financial fairy tale.
Right. But it is actually the very real, very high-stakes world of FCNRB deposits. Welcome to today's deep dive. We are unpacking a brilliant June 2026 analysis from ODFC Academy.
Yeah, it's authored by Reserve Bank of India Policy Observer Professor Sudesh Kumar.
Exactly. And, we're getting this incredible under-the-hood look at how a central bank strategically pulls macroeconomic levers to basically suck billions of dollars in foreign currency across its borders.
Which is fascinating because, on the surface, a bank deposit sounds remarkably mundane, right? You put money in, you get interest out.
Super poor.
Exactly. Professor Kumar's analysis really strips away that surface layer to reveal this hyper-competitive global battlefield. We're talking about the gravity of global interest rates, the hidden costs of currency hedging, and a central bank, the RBI, that is actively rewriting the rules of the financial plumbing.
Just to keep its economy competitive. So whether you are a legal professional advising clients on foreign exchange compliance, a corporate treasurer, or, just a curious learner trying to decode how global money actually flows, this analysis is your playbook.
It really is.
So we need to start with the mechanism itself, FCNRB. It stands for Foreign Currency Non-Resident Bank Deposits.
Right.
And these are essentially accounts for non-resident Indians, NRIs, to park their money in Indian banks. But the critical detail here is that these deposits stay in foreign currencies.
Yeah, US dollars, British pounds, euros, that is the defining feature.
Right.
The depositor earns interest on their money without absorbing an ounce of exchange rate risk.
Let's really break down why that is such a massive incentive. Because normally, chasing yield in a foreign country is a huge gamble.
Oh, absolutely.
Let's say you take your US dollars, you send them overseas, convert them to the local currency, and you're earning a juicy 8% return.
Sounds great on paper.
Right. But if that local currency depreciates by 10% against the dollar over the year, your actual return is negative when you're trying to bring your money back home.
You're losing money.
Exactly. But the FCNRB setup just sidesteps that entirely. It's like buying a VIP concert ticket in a foreign country, but the central bank personally promises to refund your exact dollar amount if the exchange rate drops before the show. The depositor takes zero currency risk.
Right, but the operative word there is depositor. Because the risk doesn't just magically disappear into the ether.
No, of course not.
It simply gets shifted onto someone else's balance sheet.
Right.
We will get into exactly whose balance sheet is taking that hit in a moment.
But from the Reserve Bank of India's perspective, this isn't just about offering a nice perk to expats.
Yeah. They view these deposits as a critical market-based tool. It's a valve they can open to attract foreign currency.
Which provides the liquidity they desperately need, right?
Exactly. To manage the national exchange rate and really fortify India's foreign exchange reserves.
So you open the valve, the dollars flow in, and the broader economic engine just keeps humming.
That's the idea.
But that brings us to the core tension of Professor Kumar's analysis. If this is already such a fantastic risk-free deal for the depositor, why are Indian banks suddenly having to aggressively hike the interest rates they offer on these accounts?
Yeah, that's a big question.
As of mid-2026, we're looking at rates pushed up to around 7.1% for a 5-year dollar deposit. Why do they need to pay such a massive premium?
Well, the answer lies in the sheer gravitational pull of global yields. Professor Kumar points out that the opportunity cost for these investors is just incredibly high right now.
Right.
If you look at the source data, safe U.S. Treasury 5-year yields are sitting comfortably around 4.2 to 4.5%.
Here's where it gets really interesting. Wait, so basically, because the U.S. economy is acting like a giant financial magnet with those 4.5% safe returns, Indian banks essentially have to pay a massive bribe-like, a premium up to 7.1% just to break that gravitational pull, just to get investors to look their way.
Bribe implies something illicit, but structurally, yeah.
Yeah.
It is simply a necessary premium to overcome opportunity cost.
Wow.
And this perfectly illustrates the foundational economic principle of interest rate parity.
Okay, unpack that for us.
So Obstfeld and Rogoff wrote about this back in 1996, and Begert in 2017 described it as this no arbitrage relationship between spot and forward exchange rates and the two nominal interest rates.
So in plain English,
capital flows to wherever it can secure the best risk-adjusted return. Money is deeply unsentimental. Arbitrageurs are constantly scanning the globe, and if the baseline risk-free return in the U.S. goes up, well, the rest of the world has to adjust their rates upward just to maintain equilibrium.
Because if the Indian banks don't offer that 7.1%, those billions of dollars just stay firmly stuck to the U.S. Treasury magnet.
Exactly. The banks have absolutely no choice but to compete on price.
Okay, I follow the logic there. They must offer higher rates to break the magnetic pull of U.S. yields. But the fatal flaw in that plan seems to be how the banks actually afford it.
Ah, yes.
If a local Indian bank is paying out 7.1% in hard U.S. dollars to the depositor, they have to be making an absolutely massive return on that money locally just to break even, right?
Oh, yeah. And the margins there must be razor thin.
Yeah.
Which leads us directly into the hidden mechanics of banking that Professor Kumar exposes.
The hidden delivery fee.
Exactly. When an Indian bank takes in $1 million US from an NRI, they don't just, lock physical pallets of cash in a basement.
That would be terrible banking.
Right. They put that capital to work. They lend it out to domestic businesses. But those local businesses operate in rupees.
Right.
So the bank converts the $1 million into rupees today, lends it out, and earns rupee-denominated interest.
But the clock is ticking. Because in 5 years, the bank owes the depositor their original $1 million, plus that 7.1% interest.
Regardless of what the rupee has done in the meantime.
Oh, wow. And that is a terrifying position for a bank.
It's a nightmare. If the rupee depreciates significantly against the dollar over those 5 years, the bank could lose a staggering amount of money just trying to buy back the dollars they owe.
So they have to manage that risk somehow.
Right. By using financial instruments called currency swaps. Essentially, they enter into a contract today that locks in the exchange rate they will use to buy back those dollars in 5 years.
So they are buying an insurance policy against the currency tanking.
Exactly. But as we know, insurance is never free. Far from it. The premium for that swap, what we call the hedging cost, is incredibly expensive. And this brings in a fundamental economic reality straight out of Menke's Principles of Economics.
Which is?
When transaction costs rise, prices must adjust to clear the market. You cannot absorb massive transaction costs without it showing up in the price. If the bank is paying a fortune to hedge the currency risk, their net funding margin just evaporates. They simply do not have the profit margin left to offer that juicy 7.1% interest rate to the NRI depositor.
So caught in a trap.
A huge one.
To put it simply, the local banks want to offer a premium product to customers to beat those U.S. treasuries. But the shipping and handling fees, like the hedging swaps, are just too expensive.
Exactly.
If they pay the depositor and pay the hedging cost, they are basically operating a charity.
Which is obviously an unsustainable model for any financial institution. And this paralysis is exactly why the Reserve Bank of India had to step in with 2 highly calibrated interventions to unblock the plumbing.
Okay, let's talk about those. The first major move happened in December 2024, right?
Yes. The RBI liberalized the interest rate ceilings on FCNR deposits.
So they basically took the regulatory brakes off so banks could legally offer higher rates.
They did, but they structured it in a very specific way. They allowed banks to offer their baseline reference rate, the ARR plus 400 basis points, for deposits with a 1 to 3 year maturity.
Okay.
But for deposits with a 3 to 5 year maturity, they bumped that ceiling up to the ARR plus 500 basis points.
Wait, hold on. So they are explicitly giving banks permission to pay a higher premium, but only if they lock the depositor's money up for half a decade.
You caught that, yes.
Why intentionally push the banks toward a 5-year timeline? Are they terrified of capital flight if they just take in 1-year deposits?
That is a very astute way to look at it. It is all about managing rollover risk. If the RBI incentivizes 1-year deposits, they're bringing in what we call hot money.
Right, it moves fast.
Exactly. The moment global interest rates shift, or there is a minor economic hiccup, all those billions of dollars mature and instantly flee the country.
Oh, I see.
By offering a higher ceiling for the 3 to 5 year window, the RBI is actively trying to stretch out the maturity profile. They are engineering sticky money that provides long-term stability for India's foreign exchange reserves.
They are buying themselves time. But giving the banks permission to offer higher rates still doesn't solve that core issue we just talked about, the crippling cost of the currency swaps.
No, it doesn't.
The RBI can raise the speed limit all they want, but if the banks can't afford the gas, nobody is driving faster.
That is a great analogy. And that realization forced the RBI's second, more aggressive intervention in June 2026.
This is the big one.
Yeah. They announced a special facility specifically designed to cover hedging costs on foreign currency deposits.
Meaning the central bank looked at the local banks and said, we need these dollars. We will literally pay your shipping and handling fees so you can keep your prices attractive.
That is exactly it. The official language the RBI used was a mandate to reduce banks' landed cost of raising dollar deposits. By stepping in and covering the cost of those currency swaps, the RBI fundamentally alters the bank's profit equation.
Wow.
The bank can now offer the high gross deposit rate to the NRI in New York, beat the U.S. Treasury yield, and still maintain a healthy net funding margin because the central bank is eating the cost of the insurance policy.
It's just an incredible display of manual macroeconomic intervention. They are subsidizing the friction right out of the system.
They really are.
But let's look at how this plays out on the ground. Because once the RBI clears the regulatory path and foots the bill for the hedging, it sets off a massive scramble among the banks themselves, doesn't it?
Oh, a total scramble. Professor Kumar highlights this as a critical driver of the current landscape. It's the intense competition and relationship effects among Indian banks.
Because they aren't all the same.
Right. You have to remember, the banking sector is not a monolith. You have massive, entrenched legacy banks, and you have much smaller, newer players.
And the behemoths already have millions of loyal NRI customers.
Exactly.
They have the brand recognition, the slick mobile apps, the historical trust. If they want to raise capital, they probably don't need to offer the absolute maximum 7.1% interest rate. People will just bank with them for the convenience and prestige at like 6.8%.
Right. Their cost of customer retention is much lower. But the smaller banks face a completely different reality. Foundational microeconomics, like from McConnell, McGuigan, and Brew, tells us that firms in highly competitive markets must price aggressively to attract the marginal customer.
The marginal customer.
Yeah, the NRI, who doesn't already have an account in India, or who is perfectly willing to switch banks for an extra 0.5% of yield.
Because if you're a new or smaller bank, nobody's handing you $1 million just because they like your logo.
No.
You literally have to buy their attention.
No.
You know, this explains so much about the current financial landscape. If you are browsing financial news online right now, you are probably seeing a relentless barrage of banner ads for ultra-high yield NRI accounts from banks you might barely recognize.
I've seen them.
Right. It looks almost suspicious if you don't know the context, but it isn't a scam. It is a textbook price war.
It's a scramble for that marginal customer.
These smaller banks desperately need fresh capital inflows, so they are the ones pushing the absolute boundaries of the RBI's new rate ceilings, using the RBI subsidized hedging facility to wage war for your dollars.
It is the perfect storm. You have intense global pressure from U.S. yields, sweeping regulatory relief, a subsidized risk environment, and pure, unfiltered market competition, driving the numbers to the absolute limit.
But, you know, every time a central bank heavily engineers a market like this, there is a dark side.
Always.
We've mapped out the brilliant mechanics of how the machine works to pull in dollars, but what are the actual consequences? Like, what are the ultimate trade-offs of the RBI manually footing the bill for all this risk?
Professor Kumar carefully weighs these scales in the analysis. The immediate tactical benefits are undeniable. By aggressively pricing these deposits, India rapidly improves its foreign exchange liquidity.
Right.
It stabilizes the rupee in the short term, and it immediately bolsters the national reserves. Financial literature like Harduvella's and Theodosis consistently demonstrates how deploying derivative securities and hedging facilities can successfully mitigate currency shocks for the broader economy in the immediate term.
Okay, but wait. If the central bank is basically underwriting the bank's currency risk to bring in these dollars, doesn't that fundamentally distort how the banks behave?
How do you mean?
Well, if I am a mid-sized bank and I know the RBI is paying for my safety net, why wouldn't I just take on an obscene amount of risk? I mean, I keep the profits if it works out, and the central bank takes the hit on the swap if it fails. Isn't this creating a massive moral hazard?
Oh, you've hit on the exact systemic vulnerability Professor Kumar warns about. Yeah. By covering the hedging costs, the RBI has not erased the risk from existence. They've simply transferred that risk directly onto their own sovereign balance sheet.
Wow.
If a central bank offers open-ended, unlimited support to cover private banking costs, you absolutely guarantee moral hazard. Banks become deeply dependent on the bailout mechanism, and market discipline completely evaporates.
So how does the RBI prevent this brilliantly engineered valve from just, turning into a systemic disaster?
The safeguard is strict calibration. Economic theory governing monetary policy like Goodhart's work insists that temporary support mechanisms must be strictly time-bound to preserve market discipline.
Okay.
If the market believes the support is permanent, the policy fails. The RBI's approach here is highly calculated. They widen the pricing space in late 2024. They remove the specific cost friction with the hedging subsidy in mid-2026, but they are keeping this window strictly time-bound.
Meaning the clock is actively ticking on the subsidy.
Exactly. The banks are acutely aware that this facility will be withdrawn. They have a very narrow window to secure their long-term funding, lock in these 3 to 5 year deposits, and repair their balance sheets before the safety net is yanked away.
So it forces them to act aggressively now.
Right, without allowing them to build a permanent business model around the central bank's generosity.
It is a phenomenal high-wire act. The central bank is essentially renting stability. They are opening the valve, covering the shipping fees, and letting the banks fight it out, all to maintain the lifeblood of India's foreign reserves.
That's a great summary.
But, this brings us to a really provocative thought about the future.
It does, and it's perhaps the most chilling takeaway from the entire analysis.
Oh, for sure.
The RBI has successfully designed a system that incentivizes an enormous influx of dollars today, specifically funneling them into those 3 to 5 year premium rate deposits.
Right, they got their sticky money.
They did. But think about the timeline here. If billions of dollars are flowing into 5-year lock-ins during the summer of 2026, what happens in the summer of 2031?
The bill comes due all at once.
A massive maturity cliff.
Wow.
By 2029 or 2031, all of those premium deposits will mature simultaneously. If global interest rates, like those benchmark U.S. Treasuries, haven't dropped significantly by then, those investors are going to look for their next high yield.
Right.
If India isn't still offering 7%, those investors will just pack up their billions of dollars and leave.
That is a staggering vulnerability. The central bank basically solved today's liquidity crisis by setting a timer on a massive withdrawal shock 5 years down the line.
Exactly.
When that cliff hits, the RBI has to somehow manage billions of dollars flowing out of the country in a matter of months, all while they're still holding the bag on those expired hedging subsidies they took onto their own balance sheet today.
It's a huge risk.
If they haven't used this 5-year window to build structural, permanent economic growth beyond just importing hot money, the currency crashes anyway.
And it highlights a really sobering reality of global finance. There are very rarely permanent solutions. There are only temporary adjustments and delayed reckonings.
That's true.
The RBI bought themselves 5 years of runway. What they do with that runway will define the next decade of their economic trajectory.
That gives all of us something major to chew on. Whether you're tracking FEMA compliance for a multinational client or just watching the global interest rate tug-of-war play out in the news, we hope this deep dive helped you look past the basic headlines.
Now let's look
You can see the actual gears turning underneath, the risks being traded, and the cliffs being built. Keep questioning the mechanics behind the money, and we'll see you on the next